All right, we've gone through the causes of debits to cash and credits to cash. What I want to do now is jump over to revenues because revenues are so important. That's the reason businesses are in business, is to generate lots of revenues and hopes to help the shareholders' wealth increase. So when would you be crediting revenues? When do you get to increase revenues? Well, the rule again is that when out goes a good or a service, when you give a good or a service to a customer. So what would be the other side to that? Well, it could be to collecting cash at the time you make the sale, but more typical is when you make a sale to a customer on account. So when you deliver a good or a service but don't get the cash right away, remember what you're getting is a piece of paper from a customer saying they'll pay you later. So let's take a look at this accounts receivable account. You have typically amounts that you are owed from your customers from prior periods, and then what happens is it will go up when you provide goods or services to customers on account, the other side being a credit to revenues. And then what will happen to those receivables is you'll eventually collect them and you'll get the cash. So hopefully now you have a good grasp of what makes accounts receivable change. It increases with sales. You debit it when you get a IOU from a customer or a receivable from a customer, and you credit it when you finally get the money. So in the end, what happens is you get money for goods or services that you delivered, but it's often a timing difference so that you have accounts receivable reflecting how much you've earned but not yet collected. The other side to this, though, could be instead of to receivables, it could have been to the unearned revenue account. In other words, if you had collected money in advance, remember we went through this earlier, you debited cash and you credited unearned revenue because you weren't allowed to credit revenues yet. Well, when you do finally earn the amounts you collected earlier, you finally get to debit unearned revenue and credit sales. So that's the other typical reason for, or other side to crediting revenues or sales. So unearned revenue, let's take a look at that. It's a liability because you basically owe a good or a service to a customer. So when you collect the money in advance, it makes that account go up, but when you subsequently earn it, it makes it go down. And then the ending balance just represents the amount you still have yet to earn.